Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Welcome to the middle of November, almost at least. We're heading into silly season now, and that means a crazy cocktail comprising that last-minute rush to meet your targets before the break, stressful holiday planning, arguments over how you're going to split your family time over this period, and all that other stuff that makes it an exciting and chaotic time of year. And of course, against this backdrop, the retail sector is gearing up for its most exciting time of the year, from Black Friday to Christmas, when an already competitive industry turns into an absolute bloodbath. Will there be some cheer this year in South Africa? I expect so, especially compared to last year. Interest rates are down a bit, the lights are on, and the economy feels better, which may well lead to better end-of-year bonuses for staff as well. And of course, that really helps retailers because then people have money to spend. They have stronger budgets, not just for Ke December Boss, that great South African concept, but also general gifts and discretionary purchases for the family. Compare this to last year when load shedding was rampant, people were stressing about the election, and the whole place just felt worse. So with that in mind, I thought I would focus this week on two local clothing retailers that released updates in the past week, although local is a relative term here. Both will be hoping for a strong finish to the year. From what I can see, one needs that more than the other in South Africa, but more on that to come. Yes, I am talking about Truworths versus the Foschini Group. Year to date, there is nothing in it from a share price perspective. Both are up around 43%, a fantastic GNU-inspired outcome. The Foschini Group is on a trailing dividend yield of 2.2% though, and Truworths is on 5%. So on a total return basis, those who picked Truworths this year are ahead. Either way, investors are absolutely smiling if they got in at the start of this year. But have share prices run too far ahead of performance? Is this a broader issue on the JSE, as I've been alluding to in recent podcasts? We are certainly going to find out one way or another in 2025 when earnings need to catch up to performance. Also, why is Truworths up 108% over 5 years, while the Foschini Group is up just 10% over the same period? The divergence in performance is staggering over that period. There's clearly a lot going on here that is worth unpacking. We start with TFG, which is innovative but perhaps a little bit too complicated. Of these two stocks, it really does feel like Truworths is the pair of grey pants and TFG is a dark green suit. Truworths is the safe, arguably even quite boring option, whereas the Foschini Group has not been shy to take risks. When it comes to deal making, there is no doubt that TFG is more active. In fact, they've just announced the acquisition of an oddly named business called White Stuff in the UK, but the really brave deal was Tapestry in South Africa around 2022. At a time when markets were uncertain and interest rates were trying to crush inflation, TFG just waded into a consumer discretionary business that sells beds and furniture, funding the deal with debt just to add even more risk to it. Like I said, a dark green suit, possibly with a highly unusual pair of shoes. Another element of the business model at TFG that is causing complications is the exposure to TFG Australia. Retail in Australia is even more dangerous than the spiders and the snakes, with South African investors incredibly wary of a country that claimed Woolworths as its most high-profile scalp. The Australian business at TFG is significant. It contributes 15.8% of revenue and 24.9% of segmental profit before tax. That's a quarter of the business. It's operating at much better margins than either South Africa or TFG London for that matter though. Things have been tough in that market, with sales down 2.4% in the latest interim period in local currency. That is still a lot better than TFG London though, down 8.2%. For context, TFG Africa was down 0.1%. So between risky deals and complicated offshore exposure with patchy performance, South African investors are always going to be a little bit scared of TFG and especially what's going on in Australia. TFG has therefore not been the market darling. Do they deserve any better than that? Don't be too quick to shun them based on interim 2025 performance released in the last week, which saw clothing sales in TFG Africa fall by 1% year on year. Now, there was a lot of clearance activity in the base period that boosted sales in an unsustainable way, and that's why I went and looked per category in the excellent disclosure, I must say, by TFG, where you can actually go and see exactly how they've done per year, per category. And over 2 years, the compound annual growth rate in clothing is 6.3%. Homeware, that's been an area of extensive investment, not least of all thanks to the Tapestry acquisition, with a 2-year CAGR of 31.5%, you obviously can't extrapolate that, and year-on-year performance of 6.1% as a better indication of what's really going on. So, at the end of the day, both core categories are delivering mid-single digits growth, which is actually not bad. Cell phones, unfortunately, are the next biggest category, and there's not much action there at all, down 7.1% year-on-year, and with a negative 2-year CAGR of minus 1.2%. So, to TFG's credit, instead of just ignoring the issue in cell phones, where there really has been minimal growth, they've built growth engines elsewhere. They've also built Bash, an excellent online idea that brings together the strength of their entire footprint. As we head into a more favorable interest rate environment, I wouldn't assume that the underperformance TFG has suffered over the past 5 years will continue. The market does seem to share that view as well, based on year-to-date performance, which is neck and neck with Truworths. This brings us neatly back to Truworths, that grey pair of pants that has taken the more simple approach to life. They haven't done any interesting deals in a long time, and they offer exposure to only the UK and South Africa without the risky inclusion of Australia. Now, the UK can be an unforgiving retail landscape as well, just ask TFG, but the recent trend at Office has been exceptional. They are clearly getting it right in terms of that business model. But before we even get to the latest update, let's set the scene. In FY24, revenue was up 18.7% at Office and down 3.9% at Truworths, the segment holding the local business. No further discussion needed there. It's pretty obvious who the winner is. When it comes to gross margin though, Truworths achieved 54.9% that year, whereas Office was only 47%, so quite a big structural difference in the businesses there. The trend, however, in gross margin is much the same as in revenue, with Office improving by 180 basis points and Truworths down 50 basis points. In other words, Office the winner once again. Gross margin, of course, only part of the story here. It's all about what happens below that, and that is where Office really came into its own last year. Operating margin for Office was 35.5% in FY24, miles ahead of Truworths at 23.1%. Again, the trajectory is actually quite amazing here. Office nearly doubled its margins year on year from 18.5% to 35.5%, whereas Truworths was down 310 basis points. So again, no contest there in terms of direction. Part of the explanation for this can be found in inventory turn, a crucial ratio in retail that explains how quickly stock is sold. Truworths turned its inventory 4 times in FY24, whereas Office managed 4.8 times, and that makes a really big difference. Again, the trend tells the story. Truworths 4.5x the previous year, so down to 4 times was a deterioration. Office, on the other hand, up from 3.8 to 4.8. Now, in the latest update covering the first 18 weeks of the new financial year, i.e. from 1 July to 3 November, we find that Truworths managed pedestrian growth of just 0.2%, and Office was up 9.7% in sterling. It actually comes in lower than that in rand, because for once, the rand has strengthened. And of course, for this reason, Truworths is investing heavily in new space at Office, and why wouldn't they? That business is doing well. But the South African side is clearly a concern. They are pretty much relying on Office right now to deliver the growth, and that is a risky situation, not just because of the rand translation risk, but also because we know how difficult retail can be in the UK. Success attracts competition, especially in a developed market like that. So in terms of picking your fighter here, how would you go about doing it? Well, unfortunately, it is quite difficult due to different reporting periods and business models to really get a clear view on how all these retailers compete against one another and how they are actually performing. But it does look as though TFG is doing a better job of adapting to the competitive environment locally, especially in the core clothing business, never mind the other areas of investment. Truworths seems to have the better business model in the UK, so it really depends on how you view those differences in growth. And when it comes to valuation, Truworths is on a PE of 12.6x and TFG is on 15.1x. So TFG continues to trade at the higher valuation multiple, which is part of why the Truworths share price performance has been better, because it really was trading practically X growth and suddenly started to actually deliver some growth, which the market was willing to believe in. Thank you very much, Office in the UK. I have no horse in this race at all. I think there are far cleaner ways to play the consumer recovery in South Africa. I've written and spoken about, for example, I am long cash build. I think that's a neater way to do it. But if I was absolutely forced to pick one of these companies with, say, a 3-year view, I would probably take the Foschini Group, but I would be doing it under duress. It just feels like they do have more growth engines right now, with Truworths having arguably neglected its South African business because the UK is doing really well. Let me know in the comments which one you would pick. I really am interested in your justification for which way you would go if you had to pick one of these retail giants. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.